Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, January 27, 2017. Again, this week we saw fresh all-time highs on Dow Jones and S&P 500 and the NASDAQ. They all gapped to all-time highs. The small caps are lagging somewhat, but they're not far behind. The QQQ and the NASDAQ, they are maybe a little bit overextended. We'll see if we get a pullback or not. But I think the risk-on environment is still very much present, and we got financials, industrials, and cyclicals at fresh all-time highs, and that's despite XRT, the retail, lagging. And of course, the laggers right now are healthcare, staples, real estate, utilities, so they're still lagging, but they're not necessarily bearish. Junk bonds again at fresh all-time highs, and this is all very excellent news for equities. However, bonds are maybe attempting to bottom, and we'll look at corporates and the treasuries. The dollar bulls are attempting to push the prices higher, and we'll see if this is the charm. And we'll look at US dollar versus Swedish Krona and Canadian dollar, and also possibly we may see a reversal in the Mexican peso. We'll look at gold in a little bit more detail, and I'll show some of the breadth indices that I follow, my proprietary indices. The GDX is looking toppy. Finally, we'll finish off with oil, which had a narrow trading week, and natural gas. All right, let's start with S&P 500 ETF SPY. So we have a gap up here, and we gapped to all-time highs. And we're basically holding this gap for the past 3 days so far. So this is all very bullish. It looks, I think this chart is just beautiful, and it's possible that this is a breakaway gap, and we may actually just continue to take off to the upside. Of course, it's also entirely possible that we do go ahead and close this gap. It's not a very large gap, but still, it's a gap that still remains. The advance in stocks is being confirmed by the advance decline line and advance decline volume lines. In other words, this advance is broad, and it's lots of stocks are participating in this advance, not just a couple of top heavy ones. Here is a S&P 500 also on a daily time frame. Here what I wanted to show is a just regular good old RSI 14 period. So here back in December of 2016, RSI became overextended. We had basically a sideways consolidation. Not really a pullback to speak of, just 3 days basically right there. And now, and then we can continue higher. Right now, RSI is not even that overbought yet. You can see that, we're just below the overbought territory basically. So what this is telling me is that it's entirely possible we're just going to continue higher. And here is S&P 500 on a weekly time frame, and if you watch my previous week's video, I pointed out this triangle consolidation. This is a weekly triangle, so, and you can also think about it as 2 inside weeks in a row, and this was quite a rare event. 2 inside weeks in a row don't happen that often, but in this case this looks like a 2 inside weeks in a row, so like a triangle consolidation, and now a breakout out of this consolidation, and it looks like so far it's looking beautiful, really. So it's entirely possible that we're going to just continue higher. How much higher is difficult to say, because it's difficult to say from where to measure this move, but you can say one way to measure is just from the low, so that's about 5%. It's entirely possible we're just going to continue another 5% higher, but it's really difficult to estimate where the price will go. All right, the Dow Jones Industrial Average also gapped up, not exactly gapped above resistance, but nevertheless it gapped, and now we have all-time highs, Dow 20,000. Looking like a very bullish chart. My subscribers, myself included, we actually bought before the election, so I'm still keeping this position open. There's really no point selling it. As far as the Dow Jones advanced decline lines, they're not exactly yet confirming this all-time highs because we have a little bit of a divergence, but how much does it mean? It's difficult to say. We could, divergences are notorious for not working out, so we can just continue higher. Here's IWM. Very large move here from before the elections. So from the low here to the high, that's about 21%. So this one is a little bit lagging, so we haven't seen the new all-time highs yet. But after 20%, 21% move, I think they're entitled to a bit of a holding period before fresh all-time highs commence. Here is a longer term chart of IWM. Here I wanted to point out that we did become overbought here in November, December. So maybe we're still kind of working off this overbought condition. And maybe we still want to have a little bit of consolidation before fresh all-time highs resume. Here's QQQ, the NASDAQ 100 ETF. This one had a bit of a rough start here during the election period. I maintained my conviction that this was a temporary weakness, and looks like we're now strongly outperforming basically. So from November lows here until, it's hard to measure actually, until now it's 11% move, pretty strong move. Also gap to all-time highs. So this could be a breakaway gap and we can just continue higher. XLK or the QQQ is confirming all-time highs with advanced decline lines, advanced decline volume. So participation is also broad in this advance. QQQ, by contrast, did become overbought now. So this is RSI. You can see that we're in overbought territory. So it's entirely possible we will maybe consolidate sideways. Like for example, here we become overbought, consolidate, and then we can consolidate sideways. Had a couple of days of negative days, and then we just continued higher. So, overbought does not mean weak. And here's XLK, the technology ETF, very similar to QQQ. Also had a bit of a rough start here. But now we have all-time highs, gap to all-time highs, and advanced decline lines are confirming all-time highs. So I see no major issues in technology. I see a bullish chart that, if we do get a pullback, I think would be a great buying opportunity. Risk-on posture, definitely. Financials at all-time highs. XLF here, strong move from the election lows. A little bit of weakness, but now fresh all-time highs. So same thing with advanced decline lines. I see a confirmation of this move. Here's consumer discretionary. I think if you watch some of my previous videos around here, I was saying that this could have been, this possibly was a buying opportunity, and looks like we have now fresh all-time highs. This one did not yet confirm as far as advanced decline lines, but then again, this one is really top heavy, so the participation here most likely is, these are not, the participation here, is from a larger cap stocks, because for example here is XRT, which is part of the discretionary sector, XLY, and you can see that it's pretty different chart. You can see that we had actually a low for the move from December highs here. I mean, it did participate in the move off from the November lows, but now it's sort of unraveled. And this is a broad retail ETF, so it's not just a couple of stocks that are underperforming. Here we see a broad underperformance. And eventually I think the bottom will be found, and this could become opportunity again, but some big names like Target, for example, reported, and these are actually multi-year lows. And here's Walmart, also is weighing, and these are also, I believe, those are 52-week lows. So, or let me see if those are 52-week lows. Yeah, this is 52-week lows. So, or rather, no, I'm sorry, this is not. This is 52-week lows. So, still underperformance. So, I think eventually XRT will, resume its uptrend, but we don't know when. And here's the industrial sector, also fresh all-time highs. There's some railroads that are breaking out to all-time highs, and diversified industrial. So it's a very strong move as well. You can see the advanced decline lines are also confirming this move. So I see no weakness right now in the offensive sectors. Industrials, financials, discretionary, and technology are all looking rather very, very bullish, basically. And here are the laggards. This is healthcare. So with the up move from it's kind of like basically choppy sideways action. I mean, it did participate a little bit in the November surge, but didn't really go much further. So healthcare is a bit of a defensive sector. Right now there is obvious risk on posture, so investors are positioning in risk on sectors. Healthcare is a bit of a defensive sector, so it's understandable it's trading sideways. But this could change in the near future, and we could see a surge in healthcare for some reason. Maybe some kind of a defensive, some kind of news comes up, and people decide to switch to more defensive posture. In fact, here's XLP, and you can see that it's already breaking out above November highs here. November, highs here. Here, XLV was not able to break out. XLP, so yes, was able to break out. So XLP looks a little bit stronger than XLV, and there's a little bit of a bullish divergence here as well. Also, I wanted to note that for XLV, for healthcare, the advanced decline line did hit all-time highs. So this is a bullish divergence. You can see that the price itself is nowhere near all-time highs. So I think there's a potential there right now. Here's real estate, very similar pattern to XLV, XLP. You can see it's attempting to break out. It seems to have broken up above the October highs here. But kind of trading sideways. If bonds decide to bottom, real estate may actually benefit. Here is utilities. You can see very similar patterns. Basically trading sideways, attempted to break out. So far, did not really have a breakout above, this highs here from October, November. But again, especially if bonds decide to break out, utilities will follow suit. And also advanced decline line also at all-time highs, and you can see that all-time highs for utilities were back here in July. So again, a bullish divergence here. And finally, here is junk bonds. Pretty clear uptrend here, all-time highs. So this is very bullish for the general stock market. Because junk bonds correlate highly to the general market. Here's a correlation coefficient, and it spends most of its time in positive territory. So to summarize, stocks are bullish, and any pullbacks should be used as a buying opportunity. All right, let's move on to bonds. This is a corporate bond ETF, investment grade corporate bond ETF. So we had a sell-off in bonds, and we had a big gap here that's still unfilled, by the way. We're kind of getting there, more attempting to get there, but we have not yet filled that gap. So I think if the bears decide to come in, I think the bears may come in around here, but we haven't gotten there yet, so we'll see where it goes. We had a initial surge here of the lows, and this, by the way, are not 52-week lows. These are just a few month lows. So I cannot yet say, like, for example, this is a weekly chart of LQD, I cannot say yet that this is a bearish chart. Yes, we had a surge to all-time highs and a big drop, but that does not mean that we're bearish now. We need to see lower lows, lower highs, and possibly 52-week lows before we even consider bear market. Here, this unfilled gap is still present. Also, we had a surge and now a pullback. And you notice that we had 1, 2, 3, 4 hammer-like candlesticks. It means in this area, the buyers are coming in. So there's buying present in this area. Additionally, this is exactly the breakout area. So it looks like we broke out and we had a throwback. So it's entirely possible that the buyers are coming in this area and we'll see further price appreciation for corporate bonds. Here is the same chart I just showed in the weekly time frame. Again, I don't think this is a bearish chart just yet. We had a all-time highs, and this looks like a normal retest of basically a breakout. We had a breakout above April 2016 highs right there in, or April 2015 highs in 2016 in March 2016 here, and the move up, strong move up, and now we just have I think we're having a normal correction basically. If we unravel further and we continue making lower lows, then we'll basically talk further. But at this point, I cannot say that we're in a bear market for bonds. TLT is more volatile, and let me just go to the weekly first. So TLT is more volatile. This one, look, big moves here, and these are indeed 52-week lows. So this one is, I'm less certain. Maybe we are in a bear market for bonds, and especially if we break this lows and head lower, then can pretty much confirm it. But at this point of the game, maybe we're in a bear market. There is still this big unfilled gap remains, so again, if the bears decide to come in, I think this would be the perfect opportunity for them. Right, moving on to the Forex universe, here's the US dollar in a daily time frame. So these are multi-year highs up here in December of last year. The rejection spike, and we followed through lower. Another rejection. So this was like a first attempt by the bulls here, but this was clearly rejected with a rejection spike. So we had further selling, another attempt by the bulls. This one also failed so far. And now we're having a third attempt by the bulls to counter-strike, I guess, an attempt to go higher. Now, I cannot say at this point if bulls are going to succeed, but it is looking, well, I guess a little better than previous attempts. We'll see where this goes, basically. It will depend on multiple factors, whether or not the bulls will succeed. Here is the US dollar in the weekly time frame, and this last week's candlestick is looking much better than the previous candlestick. This one has a distinct hammer-like quality, so in other words, the buyers did step in at the end of the week, and this is a better looking candlestick than the previous 4 candlesticks. I think the bigger, of course, support lies a little bit further down below here in December lows or end of November lows, but it's already possible that this was it for this move lower. And of course, when we get to gold, this will be reflected in the price of gold. I think this is still a very much bullish chart for US dollar. I don't think we have reversed. Euro versus US dollar, briefly, these are multi-year lows, and now we have a move higher. However, already I see quite a bit of selling pressure here, so maybe the bears are already stepping in. I think, again, a bigger resistance lies up here, because you can see we had a low, broken support, and attempted to run higher. So this was just like, now there's a ton of resistance in this area. And it's possible we're going to reattempt to go higher, here, but I don't know. Euro is in the bear market, so I don't know if this is going to go any higher. And you can see that there's this a shooting star like candlestick already. So if we move lower, maybe we'll confirm the shooting star and continue lower. This is to me, this is a bearish chart still. And even though we had like a bottom in action here, we had 4 weeks here and then finally a rally. This could be like a very temporary reprieve, and multi-year lows will continue. Here's US dollar versus Japanese yen. This one is looking distinctly stronger than the other forex currency, the other currencies. This one had, I think this may be a double bottom already. So we had a first attempt, now we had a second attempt, and this second attempt is looking very promising. So maybe the Japanese bulls are already failing, and US dollar bulls are going to attempt prices higher. And this is especially obvious on the weekly time frame. Look at this two big hammer-like candlesticks, especially the last, this week's hammer-like candlestick. If we see a little bit further follow through, I think this will be confirmed, and we can see a fresh breakout above this highs. If this happens, this will weigh on the gold significantly when we get to it also. And a couple of extra ones, US dollar versus Swedish Krona. This is part of the US dollar index, so I kind of cover it occasionally. US dollar, versus USD SEK. I think there was a breakout here, but now we're seeing a throwback to the breakout level. Also, possibly this is a hammer-like candlestick basically, and maybe we'll see follow through higher. Here's a couple of interesting charts. This is US dollar versus Canadian dollar. I'm not a big fan of slanted trend lines, but occasionally they do work, so it's entirely possible we're seeing a breakdown out of this trend line. I mean, it's possible that this is a we had a drop, and now we had a rising wedge, and then we're possibly breaking down out of it. In other words, Canadian dollar is going to be winning this battle. However, this still remains far from certain, and it's entirely possible that we will push higher from here as well. And finally, in the Forex universe, here's the dollar versus Mexican peso. Last week we hit all-time highs, in other words, all-time lows for Mexican peso, but then we had, it's possible that this is a shooting star, and also in this week we had a little bit of a gap here and a follow-through lower. So maybe we're reversing. You can see a similar pattern here, but looks like we obviously didn't reverse. So I cannot say, with certain that we are reversing. We need to see a lower low basically being made, but I haven't seen it yet. So to summarize, I think the dollar is bullish, and I think we are getting close to the end of this move. So let's look at gold and where that is going to go. Okay, so this is gold on a daily time frame, continuous contract. So a couple of weeks ago I pointed out, actually last week I pointed out this resistance area, and it's really difficult to draw exact resistance lines because there's just so much resistance up here. There's resistance from this support break, resistance from the moving averages, there's the resistance from the spike higher, so there's lots of resistance here. And for now, there is resistance in this area, which has been so far reaffirmed, and we have pushed lower. It's possible that this is also a hammer-like candlestick, so maybe we're attempting to bottom. And again, it is not yet certain that the US dollar has indeed bottomed and will now attempt to rally. Of course, if the dollar rallies, the gold will come under pressure because they move one opposite the other. Most importantly, for gold, I think this is a weekly time frame. We had an outside reversal candlestick, well, possible outside reversal candlestick. In other words, this previous week's candlestick, this white one right here, is completely engulfed by this red candlestick from this week. This could be a bearish engulfing and additionally a outside reversal, especially if we get a confirmation next week. and this will depend on the dollar, of course, as I said. Here's some of my proprietary indicators as gold on the daily time frame. So for the record, gold I think is still in a bull market, but is literally hanging by its last, by the fingernails here. So here is this gold breadth index. It's kind of like a sum total of all of the inputs that go into it. So there's quite a bit of inputs, and here are the two inputs for the GBI. Additionally, of course, these inputs have multiple raw data points. So here's one that I follow, also proprietary experimental indicator. This is a percentage of stocks within the index on a buy signal. And the bear trigger occurred back here in August, and so far we need to get to 90. So far we're not able to get to 90 on this indicator. Even just a couple of days ago we came to very close. We came to 87.5, but we did not get that final push. So far we have not gotten there yet. The one indicator that did improve is percentage of stocks in an uptrend. So I guess you can think about this. This one is a more volatile one and a little bit more short term. This one is a little bit more long term. This one, to get to bear market, we need to get to 20%, and we're about 50% right now. And actually this week we did improve a little bit. We're now at 62.5. So it's kind of like a mixed bag basically. If we push, if we attempt to break out above, this new double top, then maybe we'll improve this percentage of stocks on a buy signal. Alternatively, if we don't, we can kind of roll over and just completely unravel. That's also a possibility. Here's GDX, Gold Miners ETF on a daily time frame. So a little bit of a bullish divergence still. You can see we had a lower low in the index, lower high rather in the index, and higher highs in the advanced decline lines, and additionally in the percentage in the bullish percent index. But if gold does roll over, GDX will absolutely positively follow. Plus now we have a little bit of a shooting star candlestick here with a follow through to the downside. In fact, on the weekly time frame it's a little even more obvious, so there is clearly now resistance in this area and it's being reaffirmed. It's possible that we still pull out of this, but it will take some significant pressure to go higher, and especially we need to see dollar basically go lower from here. Alright, and here is West Texas Intermediate, light crude oil and continuous contract on the daily time frame. These are 52-week highs, so it's something to be aware of. 52-week highs are bullish. However, we had this big possible bearish engulfing, and so far, I guess if we make a new fresh 52-week highs, then I will be less convinced that this is a fake out. But for now, I'm not yet convinced that we're in a bull market for oil. It's maybe just basically a trading range between like this highs at around 62 and this lows around, well, and I'm not sure how low it will go, but maybe around $39. So maybe it's just going to be a big trading range for the time being. The important thing here on this chart is that this is an inside wick, so this is basically a narrow trading range, and it is even narrowing as we speak. So I think if we break out maybe above last week's high, so this is a 54.32. If we break out, I think we may see fresh 52-week highs. However, if we break down, I think we could see easily a move down into the upper 40s. It's entirely possible. And another thing is energy ETF XLE. I don't think it's done yet correcting, because if we just look at it purely from a point of view of breakout, we had a breakout above this highs here, above October highs here in November, and then we had 52-week highs. Now we have a corrective pattern, but I don't think it got there yet. So maybe we see further correction to around $71, $72. And if oil decides to break down out of this consolidation, I'm certain XLE will follow. And here's natural gas on the daily time frame, continuous contract. I think this is a bullish chart, 52-week highs, and this is a volatile security, so if you decide to trade it, and I actually discourage it for new traders, and when I say new, I mean, a few months to a few years in the market, you have to really be able to tolerate this large moves. I mean, look at this big gaps here, pretty wild security here. So I actually discourage new traders from trading natural gas. It's a wild one, really. In any case, this week was pretty good week. We had this week we actually gained almost 5%. I think still it's a bullish chart, so looks like the buyers did step in, but you can see that this is not a very bullish candlestick, and the reason is because of this big spike. So now I wonder if maybe this is a rejection spike, and maybe the bears are attempting to completely turn this thing around. Maybe this big gap here is a reversal, and maybe now the bears are taking advantage of it. It is not yet clear to me that this is a reversal, but I think if we break these lows, then we have to contemplate a possibility of a reversal in natural gas. On the weekly time frame, I think a longer term seems to be, natural gas seems to be still in an uptrend, and maybe this is like a breakout and now a flag consolidation, and we can see a further appreciation in price. Alright, if you like what you're hearing, please like this video, comment and share this video, and also consider signing up at MasterChartsTrading.com, so please stay tuned on how to find us on the internet. Thanks for watching, and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling, and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members, so that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right, thanks for watching, and please consider signing up for the trade alert services. Bye-bye.